Welcome back to another Real Estate 2050. This is our fifth session now, and today we'll be talking about applying for financing. Once again, my name is Q el-amin, the founder of Young Enterprise Society, and also Scott Crawford. We are a real estate development company based in Milwaukee, Wisconsin. We've developed several projects and are expanding into the campus level developments. More of why we're here today. It doesn't matter how good the design is, how good the idea is. If you can't get financing, your project really stops from there. So it's crucial to prepare yourself for financing, whether that's starting to get the equity that's needed. And I know some people say you can get into real estate with no money, but that is very hard, if not impossible. So expect at least to have 10% equity, and that may be 10,000, maybe 100,000, depending upon where you're getting into. It may be $1 million, but you're going to want to have some money for. We'll get into it later, but for pre-development, for construction, for permanent financing, and lenders are going to want to see what they call skin in the game, or some way that you're putting in funds that you can be at risk and lose. Those don't necessarily have to be your own funds. They can be investors, they can be friends and family, but prepared to have some upfront costs. So through this session, we'll break down how to prepare for financing, how to explain your background, how to secure some of those pre-development funds, and then how to approach construction permanent financing. So let's get started. If you have any questions, be sure to drop them in the comments, and I'll come back and reply as I can. Also, you always can DM us, and we'll reply for even greater response time. Thank you, and we'll get started. So this is segment one. So before we get started, I'm gonna need you to pause and have a real conversation with yourself. Please ask yourself, is this what I really want to do? Not because you saw it on Instagram, not because you saw Anthony Casey in the paper, not because it's what your friends and family telling you that you should do, but because this is really high stakes. When you are signing for loans, you're putting your savings, your credit, your house, your name and reputation, and years of work on the line every single time. So if you succeed, the rewards are incredible. But if you fail, you could really lose it all. And I know oftentimes people think you're just saying that, but when you sign personal guarantees, and I've done it myself for projects, and the project did not go as it was planned. And so the lender, thankfully they worked things out and we're working things out currently, but they could have said, no, we want you to sell your house that you and your wife and your kids live in and take the house to sell to pay their loan back. So when you're doing this, and it's nothing against anyone who doesn't want to take that risk. Some people think that you're crazy for taking that risk, and that's okay. But just know that you are taking a risk when you are signing those documents, and it's not for play that you're just signing on to these loans. Because if you don't pay them back, the banks, the lenders still do want their money. So if you're ready to move forward, let's go. So before you even apply for financing, these are some things to take into account. First, relationships. So the people that you meet are important, and especially for financing. They say you should never reach out like a cold email for financing. Yes, I've done it before. It's a thousand times easier when someone sends a warm email introducing you to a lender. And so you really want to have those early on relationships with someone who will refer you to a lender that already trusts them, and that carries more weight than the business plan, than the credit score. Uh, that's important, but that referral is kind of what gets you in the door. Next, your credit and your bills. make sure, even if you're applying, as a business, that your personal credit and your bills are paid on time. If you have credit cards, pay them to under 30%. If you can, pay them off, especially before you apply. It will just stop additional questions later on down the line. It'll also increase your credit score, and it can be a deal killer if you don't have good credit management because they feel as though if you're not paying those bills on time, then how are you going to pay the new bill or this new loan that you're taking on? And I know it seems basic, and especially if you've been on deals where you've partnered with a larger developer, they might not have cared or even looked into your financials because it didn't matter. But once you take the step and now you're the primary developer, everything's on you, they're really going to dig into those finances. They may go back 2, 3, 5 years. So make sure that those are paid on time. If you had judgments and lawsuits, if you're in uh, real estate, you're in business, you're probably going to have a lawsuit sometime or another. It's okay, but clear them up. If it's a judgment, have a payment plan, but just don't leave them outstanding and you haven't followed up, you haven't checked on them, you haven't saw what you could do to remedy the situation because those are things that really can sink your project and kill your deal if those are outstanding. Because again, it shows the lender that they're not taking care of business. Taxes, stay current. If you owe, set up a payment plan. If you can't, explore things like the offering compromise, but never just ignore it. I know sometimes taxes are the last thing we want to do. We don't want to pay. It's like the last bill, but you have to pay them. And then tax liens that are outstanding, they could be a dead end. Uh, if you're applying for PACE, and even though some of these loans say they're non-recourse, it's not on the borrower, it might be a bond deal, it may be whatever that it doesn't seem like it's on you as a developer, you as the borrower, it still is. And if you're applying for PACE, which goes for property taxes, not even the property taxes on that property could have went delinquent under your ownership. And so again, make sure everything is current on your taxes, whether that's your personal and your property taxes on deals. Your legal structure. You want to have multiple levels of layered LLCs, project-based LLCs, LLCs that own other LLCs. And remember in the operating agreements what they say. The paperwork is only needed when things go wrong, and then it's really needed. And so if you're getting sued for unpaid architectural fees, for example, is it going to your parent company? Is it going to the LLC? Where is this hitting? Who's liable? If you are a partner on the deal, and you could be a 5% partner, are you named in that suit as well? And so, although you may not have the ability to make the decision, are you still on the hook for whatever is owed? And so, in those structures, you have to make sure that you have that paperwork done because, again, that leads into financing. And when things go wrong, because ultimately on some project it will, who's liable for those fees? Child support, child support, child support, child support. If you owe child support and you apply for a low income housing tax credit deal as a developer, at least in Wisconsin, you cannot owe back child support. And yes, they do check. And so if you do, find ways to bring it current, have it wiped out, come up with some type of ulterior way so that you can be listed on these deals uh, and have your ownership. And then last but not least, your spouse. So in marital states like Wisconsin, your spouse must sign up on the loans. And so they need to be just as comfortable with the risks that you're taking that they're taking because ultimately they're still taking the risk as well. So having those early on conversations really helps in preparing so you don't get to the closing table and your wife or husband is saying, what is this? When am I signing? And then they kill the deal as well. So just keep all of those things in mind as you are preparing to apply for financing. And entrepreneurs, hey, you may have had it. I've had a lot of things in the past that I have to overcome. And so that happens. It might be bankruptcy, it might be foreclosure, it might be tax lien, it might be a judgment. And that's where you're going to need layers of explanation. So they can become your savior. So they are there to write a narrative to why this happened, how you fixed it. Remember that how you fixed it, not that it just happened, but how did you fix it? And then what you learn from it? What are you going to do differently in the future, or you have done differently in the future since that happened, so it doesn't repeat. So remember to be direct, be honest. Don't make excuses. Just show that you took some responsibility and you fixed it. So you took responsibility and you fixed it. But again, that goes back to what we were saying earlier. Don't just have things linger. Because if they linger, then they never were addressed, they never were fixed. And then you didn't really take responsibility in it. And so if you know these things are there, I already have your list explanation written. And then when someone asks you for it, you can just copy and paste, readdress it. And then each time, hopefully it gets better and you explain it better so that they wipe off whatever that negative is in their underwriting. So remember these things. Get honest with yourself before you even start this. Make sure your internal house is in order, whether that's your credit, your bills, your taxes, your lawsuit, your LLCs, your corporations, your spouse, your child support. And if you do have negative marks, which most of us do, so don't think you're by yourself in that. Make sure your letter of explanation is there. So if you can handle these, then I'll say it's time to move on. And we're going to talk a little bit more about a pre-development funding and what goes into that.